Welcome to This Explainer. Today, we are popping the hood on the global stock market. We're going to figure out exactly how asset prices are actually set, and we'll be investigating the fundamental rules and, honestly, the glitches of market efficiency.
Which brings us to a massive central mystery, right? Can anyone actually beat the market? Or is the price always right? Are we really outsmarting the crowd to find mispriced stocks, or are we just better off dumping our money into passive index funds and going to the beach? I mean, it's basically the debate that defines modern finance.
Okay, let's dive right in. Here's our roadmap. We'll start with the efficient market concept, then look at market versus intrinsic value. After that, we'll hit the factors driving market efficiency, break down the three forms of efficiency, and wrap up with anomalies and what this all means for your investments.
So let's establish the ground rules of our market mystery. Section 1. The efficient market concept.
In financial theory, an informationally efficient market is one where asset prices reflect new information super quickly and entirely rationally. Think about a perfectly efficient system. Literally all past and present data is already baked right into the price you're looking at on your screen. The absolute millisecond a new piece of data drops, trades execute so unbelievably fast that the price instantly adjusts to that new reality. Crazy, right?
But hey, if prices are constantly updating to reflect reality like that, where's the opportunity to actually make a profit? That brings us to Section 2, market versus intrinsic value.
This gap right here is the whole ballgame for investing. The difference between market value and intrinsic value. Market value is super simple. It's just the price tag. It's the transaction price an asset is currently trading for on the exchange. But intrinsic value, that is the estimated true worth of that asset, which is based on projecting out its future cash flows. Discrepancies between those two numbers, that is the entire basis for active investing. Simply put, you want to buy when the market value is lower than what you estimate the intrinsic value to be.
Now, estimating that true worth? Definitely not an exact science. Warren Buffett hit the nail on the head when he pointed out that anyone calculating intrinsic value is coming up with a highly subjective figure. I mean, it changes every time cash flow estimates are tweaked or interest rates move. But he also asserts that despite its fuzziness, intrinsic value is all important. Really, it's the only logical way to evaluate if an investment is actually attractive. So if intrinsic value is that subjective, what forces are actually pushing the market value toward it? Let's get into Section 3, factors driving market efficiency.
There are a few real-world factors that really dictate how smoothly and efficiently a market operates. First up, the sheer number of market participants and analysts. More eyes on a stock, mispricings get spotted and fixed way faster. Second is information availability, so timely financial disclosures are absolutely crucial. Third, limits to trading. Things like restrictions on short selling actually drag down market efficiency because they prevent traders from correcting prices that are way too high. And finally, transaction and information acquisition costs. High costs are a huge drag on efficiency. Bottom line, highly liquid markets with low transaction costs and tons of well-informed traders are naturally going to become the most efficient.
All right, so we know what drives efficiency, but how do we actually measure it? Let's jump to Section 4, three forms of efficiency. Eugene Fama created this really famous framework that essentially escalates the difficulty level of beating the market. It breaks down exactly what type of information is reflected in a price across three specific levels: weak, semi-strong, and strong. Let's break these down one by one, shall we? Okay, first up, the weak form. Under this form of market efficiency, prices fully reflect all past market data. We're talking historical price and trading volume trends. So if a market is weak form efficient, busting out technical analysis to look for predictable patterns in past stock charts, yeah, that's not going to help you consistently earn abnormal returns. All that historical data is already priced in. Stepping it up a notch, we have the semi-strong form. Here, prices quickly reflect all publicly known and available information. It includes all that past data from the weak form, but adds in things like financial statements, earnings announcements, economic news, the whole shebang. The crucial takeaway here is that in a semi-strong market, your standard fundamental analysis using public data won't give you any sort of edge, because, well, literally every other trader already has that exact same data. To see this in the real world, let's look at a wild day for Tesla stock back in August 2018. Right in the middle of market hours, Elon Musk tweeted that he was considering taking Tesla private at $420 a share with funding secured.
The market reacted instantly, trying to process this incredibly complex, totally unexpected public news. But if you look closely, the stock didn't quite hit that 420 mark. Traders were actively pricing in the massive confusion and uncertainty in real time, right before the idea was eventually scrapped and the price dropped. That lightning-fast digestion of public news, that is a perfect hallmark of a semi-strong, efficient market.
Finally, we hit the strong form. In a strong form, efficient market, prices fully reflect absolutely everything, all public information and all private insider information. Now, if this were completely true in reality, not even corporate insiders could earn abnormal returns. But as we know, strict securities laws against insider trading usually prevent real-world markets from ever becoming truly strong-form efficient. So private information usually isn't fully reflected in the current market price.
So, where are the actual glitches in this massive system, and what does it mean for your money? Let's wrap it up in Section 5, Anomalies and Investment Implications.
Even with the immense, mind-boggling processing power of global markets, researchers have still found several recognized market pricing anomalies, things that totally seem to contradict perfect efficiency. We're talking about momentum, where securities with high short-term returns just keep on climbing, or closed-end funds trading at weird discounts to their net asset values. There's also sluggish price adjustments right after earnings surprises, and highly predictable patterns around initial public offerings, or IPOs. These anomalies definitely offer some potential, even if fleeting, opportunities for active investors.
But you've got to ask, why do these anomalies even exist in the first place? Well, the answer usually comes down to behavioral finance. Markets aren't just cold, calculating algorithms, they are driven by human beings. And human beings have psychological biases. Things like loss aversion, herding behavior, overconfidence, and information cascades, they all cause prices to totally irrationally deviate from their true fundamental values. Honestly, it's precisely these human glitches that create the inefficiencies active managers are always trying to exploit.
Spotting an anomaly is really only half the battle, though. As one university endowment chief investment officer so perfectly put it, we consider the past history of active returns meaningless unless we understand why markets will allow those active returns to continue into the future. Think about that. Just finding some statistical glitch in past data isn't going to cut it. You have to fundamentally understand the underlying behavioral or regulatory inefficiency driving it if you're going to safely invest your money there. Which brings us to the ultimate implication for your own portfolio: active versus passive management. Look, if you believe the market is mostly efficient and that prices reflect all available information, then your best bet is passive portfolio management. Just track a broad index at the lowest possible cost and chill. But if you believe you have the tools, the data, and the unique insight to consistently find that hidden gap between market value and intrinsic value, then, my friend, you manage actively. As we wrap up this explainer, I want to leave you with a bit of a provocative thought. Given the relentless rise of algorithmic trading, artificial intelligence, and instant global data sharing, the speed at which information is processed is only accelerating. So are we pushing closer and closer to a world where beating the market becomes truly, literally impossible? It's a pretty fascinating question to ponder as you continue exploring the realities of modern finance. Thanks so much for watching, and keep on learning.